Whatever the interest the company pays, banking company to outsider is called interest expended. Trial balance has got two sides. One is called the debit side, one is called the credit side. Debit side shows asset and expenses, credit side shows income and liability. Every banking company has to prepare profit and loss account and prescribe vertical balance sheet every year. Branch adjustment, debit is a other asset, credit is a other liability. Hello my dear students, I am Dr. B.S. Subramania, called by name Dr. B.S.S., Professor in Commerce and Management, Vidhyaashram First Rate College at Temple of Excellence, MYSURU. In this session, I am going to hand Advanced Corporate Accounting 4th Semester, Unit 4, Session 1 of BCom in favor of Accounting for Banking Company, a new chapter which we are going to start. In the last session, we solved about the problems of holding company. Now we are going to take accounting for banking companies. We have got a proper schedule there in the bank. All the schedule I am going to be explained, and we have got a vertical column of balance sheet we are going to explain now. So in the next session, we are going to solve the problem. This session, I am going to explain what is the format for accounting for banking companies. We'll move on. Introduction. Every banking company has to prepare profit and loss account and prescribe vertical balance sheet every year. As per Banking Companies Act, every banking company has to keep 25% of current year net profit in statutory reserve. This is important. Every year, whatever the profit earned, out of the profit, 25% should be kept aside as a statutory reserve is a law as per the Banking Companies Act. Now we go with the format. Profit and loss account, schedule number 13, interest earned. In the interest earned, so the bank is going to be earn the interest. Interest on loan is a income to bank. Interest on cash credit is a income. Interest on overdraft is income. Discount on bill discount, I will explain. Discount on bill discount is a schedule number 13. Now, next we'll go to schedule number 14, other incomes. Schedule number 14, other income. Commission and brokerage, locker rent. By chance, if the transfer fees also come, it comes under other income. While you're solving the problem, I will explain that also. Schedule number 15. Interest expended means interest paid. Interest expended, interest on fixed deposit, interest on SP account. Expended means paid, interest on fixed deposit, interest on SP account. Whatever the interest the company pays, banking company to outsider is called interest expended. Schedule number 16. Operating expenses of the banking company. Rent and taxes, director fees, establishment, auditor fees, audit for fees, post and telegram, printing and stationery, sundry expenses and depreciation. Any more regular expenditure that will be taken into account. Then provision and contingency will be given in the adjustment. I will explain. Rebate on bills, bad debts written off, RBD, provision for taxation and proposed dividend which is calculated on paid up capital. We'll move on. Format of profit and loss account for the year ending. Here income, interest earned, schedule number 13, other income, schedule number 14, total, expenditure, interest expended paid, schedule number 15, operating expenses, schedule number 16, provision and contingency, there is no schedule for them. We have to make that amount has to be. This is total of expenditure side. Then profit and loss, net profit for the year, net profit for the year, profit of the last year, total. Then transfer to statutory 25% of the current year profit minus interim dividend paid. Whatever the difference come, that is the surplus to balance sheet. So this is transfer statutory reserve 25% of the current year profit. Then here first year, see that profit of the year, this is a profit, profit of the last year, that should be added, total profit. 25% of the current year profit should be transferred, then minus interim dividend paid. Whatever the difference comes, this will go to balance sheet. Surplus to balance sheet. Then come back to balance sheet schedule. We'll go one by one. Share capital 1, schedule number 1. Schedule number 2, reserve and surplus. In that reserve fund, add transfer from profit and loss account, then plus surplus. This total. What are the items are? Reserve and surplus is the heading. In that reserve fund, plus transfer from profit and loss account, add surplus. This is a total of reserve and surplus. Schedule number 3, deposit, current deposit, SP deposit, fixed deposit, recurring deposit, this total. So which are the deposits are? Current deposit, SP deposit, fixed deposit, recurring deposit, total. Schedule number 3. Schedule number 4, borrowings, loans from other bank, short-term loans, total. Which are loan from other bank, short loans. This goes to schedule number 4. Number 5, other liabilities and provision, unpaid expenses, unexpired discount, rebate on bills, unclaimed dividend, provision for income tax, traveler's check, creditor, deposit payable on demand, bills payable, total. What are the items are? Unpaid expenses, unexpired discount, rebate on bill, unclaimed dividend, provision for income tax, traveler's check, nothing but just like a BP, creditor, deposit payable on demand, bills payable. Schedule number 6, cash and balances with RBI. Cash in hand, cash with RBI only. Add. Cash in hand, cash with RBI. Next, schedule number 7, balances with other banks and money at call and short notice. Schedule number 7, balances with other banks and money at call and short notice. In that, balance with other banks, money at call and short notice, total. Schedule number 8, investment in government security, investment in shares and debenture, gold, this total. So, investment in government security, investment in private security, shares and debenture, gold. Schedule number 9, advances, bill purchase and discounted, cash credit and overdraft, both should be added, minus RBD. This should be deducted. Bill purchase and discounted, cash credit and overdraft, this should be added. Out of that, RBD should be deducted, reserve for bad and doubtful debts. Then, schedule number 10, fixed asset, premises, furniture. Schedule number 11, other assets, accrued interest, silver, gold, investment, silver, other asset, stamps on hand, owing by foreign correspondents, prepaid expenses, branch adjustment, debit is a other asset, credit is a other liability, library books and preliminary expenses. Schedule number 12, contingent liability, acceptance and endorsement, bill for collection, total. This is outside the balance sheet. This will be outside the balance sheet. So, balance sheet, capital and liabilities, share capital 1, reserve and surplus 2, deposit 3, borrowing 4, other liability 5. Which are the 5 items are? Share capital 1, reserve and surplus 3, that is 2, deposit 3, borrowing 4, other liabilities 5. So which are the 5 items are in the balance sheet? Number 1, share capital. Number 2, reserve and surplus. Number 3, deposit. Number 4, borrowings. Number 5, other liability. This goes in favor of total capital and liability. Regarding the asset side, we go on by number 6, cash in hand and cash with RBI. Number 7, balances with other banks and money at call and short notice. Number 8, investment. Number 9, advances. Number 10, fixed assets. Number 11, other assets. So here 6, 7, 8, 9, 10, 11. 6, cash in hand, cash with RBI. 7, balance with other banks and money at call and short notice. Next one, investment. Next one, advances. Next one, fixed asset, other. So what is 6? Cash in hand, cash with RBI. 7, balances with other banks, money at call and short notice. 8, investment. 9, advances. 10, fixed asset. 11, other asset. I will repeat. 6, 1, cash in hand, cash with RBI. Number 7, balances with other bank and money at call and short notice. 8, investment. 9, advances. 10, fixed asset. 11, other assets. Then outside the balance sheet, contingent liability schedule number 12. I will repeat once again. Cash in hand and cash with RBI 6, balances with other banks and money at call and short notice 7, investment 8, advances 9, fixed asset 10, other asset 11. Repeat, we'll come back one by one. 6th is cash in hand and cash with RBI. 7th one, balances with other bank and money at call and short notice. 8, investment. 9th, advances. 10th, fixed asset. 11th, other asset. Outside the balance sheet, they say contingent liabilities. Now, I will give some explanation for that about this banking company. So, they will give the trial balance. Trial balance has got two sides. One is called the debit side, one is called the credit side. Debit side shows asset and expenses. Credit side shows income and liability. What are the items are? Debit side shows asset, credit side shows liability, debit side shows expenses, credit side shows the income. So this is a procedure. Assume that rebate on bills. If rebate on bills is given in the adjustment, it should be deducted from schedule number 13 or it can be put into provision and contingencies. Out of that, 16, after 16, then it will come on the liability side of the balance sheet. If it is given in the adjustment, first it should be put under provision and contingency, then it will come under other liability. What is rebate on bills? When the bill is drawn by a seller draws a bill on purchaser for goods purchased. So seller is called drawer, purchaser is drawee, acceptor, purchaser, payee, receiver of the money. So, when the goods have been purchased on credit, so they have to pay the money to drawer, banker. So here, once you purchase, he will come and told the banker, drawer, I will pay this amount after certain months, 3 months. So once you purchase, he will go through the purchase list. If everything is accepted, he will write a bill. Who will write a bill? That this is purchaser write a bill given to drawer, or drawer write a bill it will given to drawee. Who go through the bill, accept the bill and return to the drawer? Who writes? Seller writes the bill and given to drawee. Drawee accept it and given back to drawer. So instead of drawer, what the banker will do, he will take about 1 month time to pay the money. By chance, if the purchaser pays the money within 20 days, some rebate and he will go to banker and show that I will pay the money because the bill is with the banker now. Now, what the purchaser has to do, after 1 month he has to pay to the banker. Banker will pay to the seller. This is a procedure. But here, if the purchaser pays the money to the banker within 20 days, so the banker will give some courtesy, that is called rebate on bill. Some discount is given by the banker, that is called rebate on bill. It is a loss to a banker, gain to a purchaser. But what the banker wants to know, she should be paid, some amount should be paid by the purchaser. When the purchaser pays that amount within 20 days or at the end of the 20 days, the amount, so whatever the total amount, out of that, some percentage of discount will be shown by, courtesy shown by the banker, give some discount or rebate on bill. It's a loss to a banker. But if it is given in the adjustment, that should become under provision and contingency first, then it will come on the liability side of the balance sheet. If it is in the trial balance, directly it will come on the liability side of the balance sheet. How it will be? If it is a trial balance, directly it will come on the liability side of the balance sheet. If it is in the adjustment, first it will come provision and contingency, or it can be deducted in schedule number 13. Then it will come on the liability side of the balance sheet. It's one of the good adjustment we got in the bank. Then we have got adjustment called RBD. Reserve for bad and doubtful debt in the adjustment. If it is given in the adjustment, first it has to come under provision and contingency. Then, while you are doing the balance sheet, out of the cash credit overdraft, whatever the amount we have got, from that we have to deduct the RBD, loans and advances we say. Schedule number 5, schedule number 6, schedule number 7, 8, 9, advance are there, where we have got cash credit, overdraft, everything almost a debtor. Out of that, RBD should be deducted. How it will be RBD? First, it will come under provision and contingency. Then it should be deducted from loans and advances. It should be deducted advances. Cash credit, bill purchase, overdraft, where we have there, we have to deduct. And what are the schedules are? Schedule number 5, 6, cash in hand and cash with RBI. Schedule number 7, balances with other bank, money at call and short notice. Schedule number 8, investment. Schedule number 9, advances. In the advance, now we have got loans, cash credit and overdraft. From that, RBD should be deducted. First, it will come under provision and contingency. Then it should be deducted in schedule number 9 under loans and advances. Then, provision for taxation. If provision for taxation given in the adjustment, it will come under provision and contingency. Then it will come under schedule number 5, other liability. So where it will come, provision and taxation, if it is given the adjustment, first it will come under provision and contingency. Then it will come under other liability. By chance, if provision for taxation is given in the trial balance, directly it will come on the liability side of the balance sheet. By chance, if the income tax is given, income tax paid is given in the trial balance, out of the provision for taxation, assume that provision for taxation is 15,000. Your income tax paid is 10,000. So here, while you are doing the other liability, provision for tax is 15, how much income tax paid? 10. Still, how much you have to pay? 5,000 will come other liability. If it is given the trial balance, if it is given in the adjustment, first it will come under provision, contingency, provision, contingency and provision. How much? This amount has to come. Then whatever the income tax paid, that should be deducted. If it is given the trial balance, directly on the other liability, 15 minus 10 is 5,000. Then, by chance, proposed dividend. Proposed dividend should be calculated on paid up capital. Paid up capital. It can be deducted from profit and surplus, or it can be put under provision and taxation, provision and contingency. Then it will come under other liabilities. First, where it will come under provision and contingencies, then it will come under other liability. Proposed dividend should be calculated on paid up capital. Then, in the schedule number 6, we got balance with other bank, money at call and short notice. Money at call and short notice. What is this? I am going to explain. Money at call. Here in banking system, there is a interdebt, we say. One bank can give a loan to another bank. The gap period is from 1 day to 14 days. So, one bank can give the loan to another bank. Somebody has taken the loan for 1 day. Next day, they will pay back. By chance, if the loan totally maximum, so 1 day to 14 days maximum. Here, the maximum days is 14 days. So before 14 days, by chance, is that gap in maximum range. Before that, bank will give a notice to the other bank to pay back the debt. So they have got 3 days notice. Within 3 days, the maximum number of days is 14. Within that day, they have to pay. So that they will send what's called notice. 3 days notice will be given by the banker. They have to pay back. One other bank has to pay back within that 3 days. The maximum number of days available is only 14. 1 day to 14 days. So they can pay 1 day, call. They does not give any notice out there. If they not paid, then the notice will be issued by the man who gives the loan to other bank. They will issue the notice. 3-day notice will be given. They have to pay back that particular money within 3 days. The maximum number of days allowable is 14 days. This is called money at call and short notice. These are all the important points. So provision, and there is another point is there. Your investment in trial balance is equal to 4 lakh. This is as per trial balance. But investment in adjustment is 3,50,000. What's the real value? 4 lakh. But as per adjustment, 3 lakh fee. Fall in the investment is 50,000. For that, you have to create an account called investment fluctuation reserve to the extent of 50,000. So that 50,000 will come under other reserve and surplus. You have to create an account called investment fluctuation reserve. By chance, you already got this investment fluctuation reserve 60,000. How much fall now? 50,000. 50,000 should be deducted from the investment fluctuation fund. The difference will be appearing on the liability side of the balance sheet under the reserve and surplus. What's the original value? 3 lakh. Today, the market value 3 lakh 50. How much has fallen down? 50,000 loss. We have to create an investment fluctuation reserve. Already, we have got investment fluctuation reserve. How much is there? 60,000. But how much loss? 50. Still, we have got investment reserve 10,000. Unless we have to create an investment fluctuation reserve. These are all the only thing adjustment will come. One is rebate on bills, where it will come. Rebate in the bill adjustment under provision and contingencies. Then it will come under other liability. RBD under provision and contingency. Then it should be deducted from loans and advances on schedule number 9. Then provision for taxation is given in the adjustment. First, it will come under provision and contingency. then it will come under other liability. If it is given in the trial balance, directly it will come under other liability. If the income tax paid is there, that should be deducted. Proposed dividend should be calculated and paid up capital. That will come under provision and contingencies. Then it will come under other liability, or it can be deducted from surplus also. Then regarding the investment in 4 lakh is there. Here in the adjustment 3,50,000. There is a fall in the value of 50,000. Already we have got investment reserve 60,000. How much fall in the value? 50. The balance is 10,000. So this is first you have to learn schedule. Schedule number 13, interest earned, that is interest and discount. Schedule number 14, other incomes, that is commission and brokerage, rent, that is a locker rent. Schedule number 15, interest expended, interest paid by the bank. Schedule number 14, so first one, schedule number 13, interest earned. Schedule number 14, other income. Schedule number 13, 14 over. Schedule number 15, interest expended. Schedule number 16, operating expenses. Then provision and contingencies. Now, come back to balance sheet schedule. In the balance sheet, schedule number 1, share capital. Schedule number 2, reserve and surplus. Schedule number 3, deposit. Schedule number 4, borrowing. Schedule number 5, other liability. This goes in favor of liability side. Come back to asset side. Schedule number 6, cash in hand, cash with RBI. Schedule number 7, balances with other bank, money at call and short notice. So 6, 7 over. 8 is the investment. 9th is the advances. 10th is the fixed asset. 11th is the other asset. I will repeat. Cash in hand and cash with RBI is schedule number 6. Balances with other bank, money at call and short notice is the 7. 8 is the investment. 9th is the advances. 10th is the fixed asset. 11th is the other asset. And 12, provision and contingency. Repeat once again. Cash in hand and cash with RBI 6. Balances other bank and money at call is 7, 6, 7. 8th is the investment. 9th is the advances. 10th is the fixed asset. 11th is the other asset. Outside the balance sheet, contingent liabilities. Here, schedule liability side, schedule number 1, share capital. Schedule number 2, reserve and surplus. Schedule number 3, deposit. Schedule number 4, borrowing. Schedule number 5, other liability. Hope you understand. I will explain all the adjustment detailedly regarding this. No, you must be very careful. While you're solving the problem, I will explain once again. Hope you understand the format. In the next session, we'll start the problem about the banking. 15 marks question. Very easy. Only you have to learn the format. Mug up the format. Write so many times the format in the buff sheet. Learn the format. And whatever the adjustment come, I will explain what regarding the format. You have to learn that format. You mug up the format. One is you have got profit and loss account format, balance sheet format. Once you learn, just fill up the blank. All the items will be given by the here trial balance. You have to fill up the blank. Hope you understand. We'll meet in the next session with a problem. Till then, goodbye. Meet in the next session.